Hello there. Welcome to part 2 of this Forex Broker series where I'm teaching you everything you need to know about Forex brokers. If you've joined the series here, go back and watch part 1. It's important you start from the beginning to get the most out of this series. This slide is from the previous video. I went through it. I don't need to tell you how amazing I am again. Something I didn't mention, just to give you a bit of a snippet into my life. I'm a real geek, so I'm a real nerd. I love Star Wars. I love Pokemon. I love old games. I love like Final Fantasy, if you've ever played one of those games. Kingdom Hearts. I love it. I'm a real geek. I love to read. I read lots of trading books and I read lots of like Star Wars books. So there we go. That's enough about me. Forex Brokers Explained. This is part 2. I'm going to cover the costs involved in trading with a Forex broker, using a Forex broker. Nothing will be hidden. I will lay out everything that's involved when you're trading using a broker. So the costs and fees involved, to jump right in, the first is commissions. So most brokers, not all, but most brokers will charge a commission per trade. So if I buy Euro US dollar, there will be a commission. If I go short New Zealand dollar Japanese yen, there will be a commission. And that commission is generally percentage based. So the bigger the trade, the more I put down on a trade, the bigger that commission is going to be. But these commissions are very small. It's a very small percentage. It's hardly noticeable, especially for bigger trades that you're holding for a long period of time. So don't get too concerned about commissions when comparing Forex brokers. The commission should never really be a reason to choose a Forex broker because it's a very small amount. Okay, so that's the first thing you're going to pay out for with most Forex brokers is a commission per trade. Now, what Forex brokers don't do is have like a monthly charge or some sort of account maintenance charge. That used to be very common with share dealing accounts, like an account with a stock broker. They would charge you like a monthly or quarterly fee. That doesn't exist in the Forex trading industry. So there's no like ongoing account maintenance charges or anything like that. It's purely costs and fees when you trade. If you're making trades, there'll be costs and fees involved. And the first here to mention is that commission. Number 2 is spreads. And I mentioned spreads in part 1. Another reason why you should go back and watch from the beginning. So what are spreads? Spreads are the difference between the actual exchange rate and the rate offered to you to buy and sell. So when I mentioned foreign exchange booths in my previous video, the exchange rate might be $1.63 for £1, but the booth is giving you $1.53, a 10-cent difference. That is the spread. The difference between the actual price, the actual exchange rate, the trading price, the market price, and the price that you can buy and sell at. Spreads are one of the ways that brokers make money, and all Forex brokers have spreads. So it's important that you do choose a broker with tight spreads. And the spreads, once again, are very small, but they can be quite wide with some brokers. And what I'll do in a later video is go through some of the tighter spread brokers. If you're taking lots of trades, these spreads can build up. So it's good to have a broker with tight spreads. So low commissions, tight spreads. The spread is more important than the commission. And what I'll do is I'll go through spreads in a bit more detail on the next slide. And I'll also go through overnight interest in more detail in a future slide. But if you're holding a position overnight, you'll likely pay or receive some sort of interest. So once again, these costs and fees are involved in actually trading. If you're not trading, there are not really any costs involved. If you place a trade, you're going to pay a commission. When you enter the trade, you're going to pay some sort of spread when you enter and when you exit. And if you're holding a position overnight, there's going to be some sort of overnight interest. And that interest is calculated based on the interest rates of the country currencies that you're holding. So if I'm holding Australian dollars and the interest rate is X amount, and I'm selling Swiss franc and the interest rate is X amount, it's those interest rates, those central bank interest rates, that are major variables in that interest rate that you pay. But I'll go through interest rates in a bit more detail in a moment. Leverage fees. If you're trading on leverage, you'll likely get a daily fee. And often that fee is incurred the same time as the overnight interest. So they come out at the same time, generally like midnight or 10 o'clock here in the UK. If you're using leverage, you'll pay some sort of leverage fee. It's not usually called leverage fee. It's usually called financing costs, something like that. Now, what is leverage? I'll put a video in the description below that teaches you all about leverage. But to keep things simple, leverage is the amount of capital you can borrow to trade with. It enables you to trade on margin. So if I want to open an account with a broker and I've only got $500, £500, 500 euros, so I do that. But I want to take a trade that requires £5,000, $5,000, 5,000 euros. I can do that with leverage. So you can hold larger positions than you actually have the account for. So I could fund a trade with a 10% margin, meaning I'm only putting 10% of the actual cost of the position, the size of the position, into the trade. So if there's a 1 to 10 leverage, that'll be a 10% margin. Okay, if I was putting 5% into a trade, 5% margin, that was the requirement, then that would be a 1 to 20 leverage. Again, leverage is generally 1 to 30. That's standard in the Forex trading industry. It can go much higher, and there are risks involved in using very high leverage. And that's all covered in the video below. So have a look at that. It'll be hard for you to make money trading Forex without some sort of leverage. So you might be thinking to yourself, well, I just won't use leverage, so I won't incur a daily fee. You really do need to use leverage because the movements in the foreign exchange market are quite small most of the time. But those small moves can equal a huge return if you're using leverage. The last thing here is withdrawal fees. So generally there's no cost involved in depositing your funds with a broker, but if you're going to withdraw, there might be like an administrative charge. Might not be, but some brokers do have some sort of like administration fee. Once again, it's quite small. For my brokers, if I withdraw more than once a month, so I can draw once a month free of charge. If I withdraw more than that, there's generally like a £5 to £10 fee for doing so. But some brokers I use don't have any withdrawal fee at all. Okay. Any questions about that? Use the comment section below. So commissions, spreads, overnight interest, daily leverage fees, which is usually financing charges or financing fees. That's how your broker may word it. And then withdrawal fees. They're all the costs and fees you need to be aware of. And once again, these are only really incurred, apart from the withdrawal charge, if you're actually trading. If you're not trading, you're not going to incur any costs.
There was once a day that I would pray for you. I'd go and misbehave just so you'd notice too. Sneaking looks up and down from across the room. And damn, what a hell of a view. I feel good, you look great, I like you, I can't wait. A first time, a first date, you're so fine, on, I'm so late. You sip wine, I drink straight. Don't waste time to my place.
So spreads. As mentioned already, it's the difference between the market price, the actual exchange rate, and the buy and sell price offered by your broker. And spreads will vary depending on the broker. And this is one of the ways that brokers can be competitive, is by offering small or tight spreads. Spreads can be variable or fixed. Now, in the last 15 years I've been trading, I would say the first 5 years there was quite a few fixed spread brokers. That means the spread was always the same no matter what. Nowadays, spreads are variable. They're constantly changing. So the spread could be anywhere from, say, 0.1 pips to 0.5 pips to 1 pip to 2 pips within a 24-hour period. So the spread changes. You know, that buy-sell premium is fluctuating constantly. And what causes that fluctuation is generally how liquid a market is. So when a market's very liquid and there's lots of people buying and selling, those spreads are generally very tight. So it's a good time to be buying and selling. Good time to be trading is when there's lots of liquid. And the most liquid time for the foreign exchange markets is the European session and the US session. Okay, so here in the UK, it's generally from about 6 o'clock in the morning to 8, 9 o'clock on an evening. And then in the US, you're talking about very early morning in the US to early afternoon in the US. So those spreads are changing all the time, and nearly all brokers nowadays offer variable spreads. There's no real decent brokers out there anymore that offer fixed spreads. I never liked fixed spreads anyway, because they were generally very big to cover the times when liquidity was low. Spread widening. Okay, so when liquidity is low, spreads will get wider. As mentioned, when there's lots of people buying and selling, spreads are tight. So the opposite is true. When there's not as many people buying and selling, when things are not as liquid, spreads can be wider. And things to look out for are brokers that really widen spreads during news events. So when there's big news, liquidity can drop, markets can become volatile, and spreads can really widen. When markets close, you know, the Forex market is 24 hours a day, but there is like an official closing time at 10 o'clock UK time, which is 5 o'clock Eastern Standard Time, which is 5 o'clock office hour close in New York. Spreads can widen then as well, and also during holidays. So July the 4th, which is today, Independence Day, and other holidays where traders are off over the Christmas period, as an example, spreads can really widen because there's not as much liquidity in the market. So they're things to look out for. And in a future video, I will recommend some brokers that have tight spreads, and also brokers that don't really widen their spreads much during these periods of low liquidity. Swap rates. Okay, so this is going back to that overnight interest. This is something you do need to be aware of. I'm trying to teach you everything here. If it's not sinking in, if it's too much, if it's overwhelming, watch the video again and ask me questions below. Okay, so swap rates. That's the overnight interest. Central banks set interest rates. And there's been a lot in the media about this lately, as interest rates have been climbing and are currently quite high across the globe. Now, the swap rate is calculated, this is the real basics, the swap rate is calculated against the currency you bought and the currency you sold. So if you went long Euro US dollar, you're buying euros and selling dollars. If you buy Australian dollar, Japanese yen, you're buying Australian dollars and selling yen. If you go short pound US dollar, you're selling pounds, buying US dollars. If you go short US dollar, Canadian dollar, you're selling dollars, buying Canadian dollars. So understanding that will help you understand how the swap rate is calculated, because you're comparing the interest rates between what you've bought and what you've sold. So if I bought, say, pound Japanese yen, the interest rate might be about 5% here in the UK, and for Japan, the currency which I've sold, the interest rate might be, say, 0.5%. So there's a difference there. And what I've bought minus what I've sold might give me an interest rate of 4.5%. That would incur a positive swap rate, meaning I will earn interest on that trade every single night. Okay? If the interest rate turns negative, you have a negative swap rate, which is going to happen most of the time. You have a negative swap rate and pay interest every night. So if I use the same example but flip things around, if I went short pound yen, so if I bought yen and sold pounds, I've bought at 0.5% interest, I've sold at 5% interest, that gives me negative 4.5%. I'll be paying a swap rate every day, usually overnight, when the overnight fees, the leverage fees, are calculated and deducted. Let's look at one more example. So if I was to buy US dollars and sell euros, so if I went short euro US dollar, so sell euros, buy US dollars, if the interest rate hypothetically is 3% for the US and 5% for the currency I've sold, the euro, I would have a negative 2%, negative swap rate and pay. Now there's a bit more to it than that, because the broker will have other fees and have a formula to calculate this out. If interest rates are very similar, you'll likely have a negative interest rate, just the way they calculate it. But you can make money through positive swap rates, and some people do that, and that's called carry trading, or taking a carry trade. They're making a positive return every night. It's paid into their brokerage account because they've bought a currency with a high interest rate and sold one with a low interest rate. I think that is it. Okay. So the costs and fees that you will pay out trading are these. And for some brokers, it will be all of these. For some, it will perhaps be 3 or 4 of these. The real competition is in the spreads. Try and find a broker with tight spreads. Some brokers won't offer a commission, and you'll think, wow, commission-free trading. This is very popular nowadays, is commission-free trading. But what they're doing is actually increasing the spreads. So you're paying a premium spread because there's no commission. And I discourage that. Try and get a broker that offers tight spreads, even if you're paying a commission per trade. Okay, that ends part 2, and I'll speak to you in part 3. Please like, please subscribe, use the comment section below, and I'll speak to you in the next video.